Hi everyone, welcome to another video of what's moving the markets. So most of you probably know that the latest inflation data just came out. So we're going to be talking about that, what it means for the Federal Reserve's upcoming meeting. Are they expected to cut the interest rate? And what has China been doing all this time? And how does that tie in to what's happening with the US economy? Very interesting developments. So let's get into it. So number one, obviously the inflation is cooling down, right? We saw that with the latest data that came in today, and the market is pricing in an interest rate cut. And what that means is, the way we can see that is through something called the Fed Watch tool. And that is something I have shown you in earlier videos, where based on derivative prices, we can work backwards and figure out what's the probability that the market is pricing in a cut. And the way it looks like right now, it's a very high probability that the interest rate is going to be reduced a little bit more, which is in line with what we have been saying for a number of months now, that it's going to be a slow easing, right? Of course, not investment advice, but this is how we see it, and you should do your own due diligence. But by the looks of things, we are going to continue with a slow easing. Now, something that makes it even more confirmed that we are going for a loose monetary policy going forward is what the Chinese government did on Monday, which was 2 days back. So they have something called a Politburo, and they've come out and basically clearly sent a message that they are going to have a loose monetary policy as well. Why are they doing that? Because they would like to continue to be able to export goods and services from China, and mainly goods obviously, to the US. Now, if USA is putting tariffs, let's say something which is made in China for $100, and USA says, hey, I'm going to put a 60% tariff on that. So now somebody from America, if they want to buy that thing, it's going to cost them not 100, but 100 plus 60, which is 160. Which then this person would think, hey, why should I buy this? Why shouldn't I buy a local option? So instead of, let's say, buying a BYD electric vehicle, why don't I buy a Tesla vehicle, which is, let's say, cheaper for 105? So instead of buying this for 100, they will go for the 105 and not buy the Chinese goods. So China's response is that, okay, in yuan, let's say this was worth 700 yuan, right? And if I make the yuan weak compared to the dollar, then in dollar terms, maybe this will be worth just $80. So even after the tariff, it might still be able to compete with local US products. So their response seems to be that, okay, you want to put a tariff to us, we're not going to just accept it and not do nothing about it. We are going to make our currency become weaker, so that from the American buyer's perspective, our products are still attractive, because in dollar terms, they will still be attractive because the yuan will be much weaker. So what does that mean then from the American perspective? How is the US government going to then respond to that? Because already what we are seeing in America is that inflation is coming down. Now, I know that sounds a bit counterintuitive, that prices have gone up year over year, to 2.7. So why are you saying it's coming down? Prices are still going up, but at a lower rate, right? So it used to be like 7 and then 6 and then 5 and then 4 and then 3. And now, of course, we are getting close to 2, which is the target of the Federal Reserve. So that's why the market is quite convinced that the Federal Reserve is going to cut the interest rate. Why did the Fed increase the interest rate in the first place? Because inflation was very high. Now that it has come down from 7 to close to 2, right? They are going to ease the monetary policy, which means lowering the interest rate. And that's good for growth-oriented companies. Why? And this is something we have talked about earlier, and let's talk about it again, that growth-oriented companies have their cash flows way out into the future. And in terms of their present value, we have to discount them back to today using the interest rate. And if the interest rate is lower, then we have to discount them back less. And therefore, the present value becomes more. So a lower interest rate is good for the growth sectors. Plus, something very interesting which is happening in one of our favorite growth sectors, which is technology, is artificial intelligence, right? And on one side, I've been telling you guys, please be careful with the semiconductor space. Please be careful with the infrastructure layer. Focus more on the application layer. And I have been telling you to focus on Google and Microsoft. And look at what happened, right? So NASDAQ went up, it crossed 20,000 compared to S&P 500, compared to Dow Jones. There has been wonderful outperformance by NASDAQ, and that is due not to the semiconductor, but to the application layer, and mainly due to Google coming out with Gemini 2.0, which can not only give you text, but also images and audio, right? So extremely interesting development. And it's in line with what we have been saying, that focus on the application layer, which is Microsoft, Google, maybe Meta a little bit, right? Because they've all invested in data centers. Yes, they've purchased all the semiconductors, and now they are developing their large language models based on this huge data center space that they have. And they're expected to get clean energy to provide electricity to it as well, with their developments of the small modular reactors, which we talked about last time. So very, very interesting developments happening over here. And tie that in with what the Chinese Politburo announced on Monday. So you have to understand this. On one hand, inflation is coming down in the US. Federal Reserve is easing the monetary policy. The Chinese government is also saying we're going to go for a loose monetary policy, which means what? It means a weaker yuan. And this is something that happened in the previous Trump government as well, right? That China kept making its currency weak, and the US had to counter it by also keeping a loose monetary policy, which means low interest rates and high money supply. The other economies have to do it as well. And what that leads into is a currency war. Printing machines, money printing going on everywhere, right? Liquidity glut. Everywhere has to keep printing money, and that's China, that's the US and other countries as well, because they don't want, like for example, I just gave you the example of the American government. If they keep the dollar strong, then the yuan will get weak, and from the perspective of American customers, they will still want to buy Chinese goods because they'll be cheaper for them, even after the tariffs are there, right? So it will counter the whole point of putting the tariffs, where the American government wants people to buy American products, but they'll still want to buy Chinese products because those will still be cheaper if the Chinese currency becomes cheap. So not only will the US government have to put tariffs, they will also have to pump out US dollars so that there is the same amount of US dollars that is there compared to the yuan, so that they don't get weak either way, right? It's kind of a balancing act, which means other countries will also have to print money, and then that just leads to a liquidity glut, lot of money floating around, which could spark speculative bubbles in equity and real estate, which is good for us, right? I mean, we can make money in all of this if you know which sectors would benefit. And of course, application layer of AI is definitely in a very, very sweet place. So Google, Microsoft is something we have been talking about, and you just saw what Google has done, right? This is something that we have been talking about, so it's not a surprise. Plus, I mean, I always say gold, 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 right? So you take this liquidity glut, and of course, it's good for equities, selected real estate, but it is also very, very good for gold, because gold supply is limited. So if you keep pumping out money, right, but the amount of gold that is being mined is, of course, not that much. There is a limited supply. So then clearly the gold price goes up. And it's not just this liquidity glut. I mean, it's also geopolitical tensions, uncertainty. And we'll talk a little bit about Syria and Taiwan as well. But yeah, I mean, the big picture is tech sector and equities. I will also shortly talk about some other sectors as well, which we have in the past discussed, and I'll reiterate them today. But mainly tech, application layer tech, and gold, right? Those are very, very sweetly placed. But apart from that, yes, financials continue to be very attractive. The reason for that is the high interest rates. So even though we are saying interest rates are coming down, but they're not coming down that much. It's a very, very slow easing, and they're just higher for longer. And plus the deregulation that we have talked about many times, that their capital requirements are expected to be eased. So obviously these guys are very sweetly placed right now. Plus, in terms of the energy independence policy, which we have talked about many times, so that still stands. You can continue to take exposure within the energy sector as far as it is domestic in nature, which means shale production and shale refinery, right, within the US. And of course, clean energy, solar energy, wind. So we talked about renewal. We gave you some examples last time, and those still seem to be very sweetly placed. And of course, just to reiterate again, something we discussed last time, industrials. So Caterpillar, Deere and Company, still very, very sweetly placed, because obviously it is local domestic focused growth. So the US, of course, is continuing with the policies. I don't know if you guys had a chance to watch President Trump's interview to meet the press. So that's the first interview he gave since the election. So it's quite clear that he's sticking to what he has been saying throughout the campaigning and as well. And we had based all this analysis on that, right? So all of this is still valid. No changes here. And again, the best one, technology application layer. And this is something I've been telling you guys for weeks. And look at how Google, or of course Alphabet, which is their corporate name, has come out with this new version of Gemini 2.0, which is not just text, but media, right? Images. And it's just amazing. Audio as well. Plus, something that we talked about last time, and let me remind you again, that supply chain realignments. So you've got US coming up with this very strong stance against China, which means trade will flow through Mexico to the US markets, even though it might be Chinese goods, but they might get assembled in Mexico and then further supplied to the US, or it could flow through via Vietnam, or it could be completely made in India as well, right? So India definitely stands to benefit. Vietnam definitely stands to benefit. You could take diversified exposures through these ETFs that I have mentioned here, or you could take whatever method of taking those exposures that you like. Last time we even talked about individual companies that could be there in these countries. Again, not investment advice, do your own due diligence, but these are some things that definitely could be considered. Now, as promised, let's talk a little bit about geopolitical updates and bring the conclusion again to the final loop back in. So, very uh, unexpected developments in Syria, and unexpected in the sense that it all happened so quickly, right? So, it just gives you a little bit of confirmation that there is still a lot of uncertainty and instability that is there, right? And then you had this Chinese military build-up happen in Taiwan this past few days. So these things are not going away so easily. It's there, which keeps bringing me back to gold, right? So please, you should continue to consider exposure to gold, and not just in terms of speculate on the price, but maybe you could add some gold mining stocks, right? So even if the price doesn't shoot up, but it stays, let's say, between $2,700 and $2,600 per troy ounce, that's a pretty high price, because I mean, if it's costing the gold miners around 1,700 to take out to mine and refine, then they've got a very nice margin here, right? So you could take exposure on gold mining stocks. Also, I've been telling you to stay away from semiconductors, right? If you want to take exposure in technology, please do it on the application layer, such as Microsoft and Google, and you can see that that has paid off and will most likely continue to pay off into the future. Plus, as far as local US domestic economy oriented investments are concerned, you can definitely go for energy and financials, which we just discussed over here, financials and energy. But within energy, I personally think that renewables are also very, very sweetly placed. You could look at First Solar, and because of that, Tesla. You can look at Caterpillar and Deere, which we already talked about, and some industrials apart from these also could be interesting. We have talked about many stocks in previous videos, right? And of course, from an emerging market perspective, India and Vietnam are very interesting options, and you can look at Mexico as well. So that is it for this week. Hope you enjoyed it. If you found it useful, please like, share, and subscribe. And of course, as always, please leave some comments below so we can interact with you. Thank you, and see you next week.